Good morning from our global headquarters in New York. I'm Menace Granny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
Yen's moment of truth. The latest rally is at risk ahead of decisions from the BOJ and the Fed. Falling out of favor, Apple's iPhone drops from the top 5 smartphones in China. And counting down to PCE, markets await the last round of key data ahead of the Fed. Some breaking news, Manus.
A little bit of breaking news. This is the endorsement probably a lot of people have been waiting for. This is Barack and Michelle Obama endorsing Kamala Harris for president. So it's very, very interesting. There's a video that goes with this. We'll catch up with that a little bit later on. But it's an endorsement, and they say passing the torch from one black president, from the first black president, one should say. And Obama said one of the youngest, of course, Obama was one of the youngest ever elected to the White House.
Yeah, and there had been some criticism in some circles and just some questions over why Obama hadn't endorsed her up to this point. The reporting had suggested that he didn't want to be seen as overseeing her coordination. But it's not just the endorsement that's important here, Manus. There has also been a lot of reporting that behind the scenes, the Obamas have been doing a lot of work. The former President Barack Obama himself apparently has been checking in with her nearly every single day. And he's been a sounding board and checking in with former aides that he thinks can help them.
Look, perception is everything. You know, to get the number of votes that she got on Monday night, to raise the amount of money that she raised within the 24 hours, it's a significant self-endorsement without the ratification, let's say, of the royalty within the Democratic Party. Barack said, we called to say Michelle and I couldn't be prouder to endorse you. And Michelle Obama said, I'm proud of you. This is going to be historic. And, of course, Kamala Harris has now joined TikTok. Bit of a competition out there between me and Kamala. I just want to put that out there. I think she's winning. You know, there's no need to get pointed about it. She's tripled her following to 1.7 million.
Yeah, unfortunately.
I'm lagging.
I was going to say, unfortunately, you can't run for president. Or I'm sure your TikTok following would be equally as robust.
It's my Bloomberg TikTok, not my personal TikTok that is lit up. But look, it's interesting. She's cutting through everything. This is the whole point. She is taking President Trump, former President Trump, head-to-head. He's got 9.5 million on TikTok. This is about using every single conduit of communication.
And I will just say, Obama draws a big crowd. If he's going to be out there, not just on the campaign stump for her, but fundraising, it is a big boon to her campaign. Absolutely.
There are other things to check. Have you anything left in you? Because you've been wiped out with equities, over 4% down in your NASDAQ this week. You've got to really review both the Fed, the AI, and the U.S. consumer. It's a recalibration. Now, Danny and I have had... Oh, there you go. Up over 1%. Danny was quibbling over the 0.4%. But we have this reassertion in the NASDAQ this morning, up over 1%. Still, the small caps have outperformed the big caps by 10%. So this rates rotation trade is still very there. Julian Emmanuel at Evercore say, is this correction over? No. Keep an eye on a couple of the other stocks that are on the move this morning. You've got Apple dropping out of the top 5 in China, but it doesn't seem to have injured it so far. There's the Apple price up 1 1/8 at the moment. On the bond markets, of course, you had that solid GDP yesterday, and that just stalled the steepener. The 7s were taken well, in actual fact, better than the 5s, and we gorged on the 2s at the start of the week. But the big story is, of course, dollar-yen. The ascent of the yen stalled, and it stalled after the GDP numbers yesterday. The bulls are vulnerable in the yen. That seems to be the building consensus. There's a vulnerability if the Bank of Japan doesn't go, and they're not likely to go, is the consensus in the stats, with a hike next week.
It's all these consensus traits that have just gone absolutely washed out over the past couple weeks, yen being one of them. And that, of course, has consequences because it is such a funding currency. And the question, we're going to get into this with our analysts in just a moment, but this idea of, is this just a washout of positioning, or is this a fundamental move that has some legs?
Well, I still think if you talk to somebody like Kit Jukes, and I did on the IB this morning, he said you're still more likely to see 140 than you are to see 160. And I mean, he has been banging that drum. But this comes down to what is the scale and the pace of the cutting from the Fed. Because that will determine whether you want to be back in your carry trades or not.
Or if you have a President Trump who wants to do something that looks like a Plaza Accord trying to weaken the dollar. So let's get into this. So just to check the current yen level, it's just above 154 this morning. We're going to get the latest inflation data out of Tokyo. That has hit. It keeps the bets alive on a BOJ hike. Let's bring in Bloomberg's Vasilis Karaminas, who joins us now. And Vasilis, Menace and I were discussing this. This is the question. Is this just a washout of positions that's moved too far too quick? Or is there any fundamental juice to continue a yen strengthening?
Yeah, Heather. Certainly we see a big positioning adjustment in dollar yen. It was the most crowded trade in the Z10 currency market throughout the year. What we're seeing right now is a repeat of price action we saw back in November, December, when dollar yen at the time fell from 150 to 140. Now we have the move from 160 to 152 within a 2-week period. At the time was a 2-month period, down to the same narrative that basically narrower interest rate differentials between Japan and the US. This time around, what was also quite interesting because it came at play at once, all these factors together. First off, we had Japanese intervention coming in, changing the rules of the game because there was no real volatility in the yen. The yen was not weakening. Basically, it was a lower US yields play from Japan's Ministry of Finance. Then we had Donald Trump's interview with Bloomberg Business Week, where he actually, raised concern to the market that, hey, maybe an administration by Trump, if he's reelected in November, will pursue a dollar devaluation policy. And maybe his reelection should not be seen definitely as a dollar tailwind due to his inflationary policies. And then the third thing was risk aversion with global stocks falling, the big carry trading effects taking a hit. So all this together created, this heavy selling in dollar yen, which has, the big fundamental narrative behind it to support it and to fall further. But cautious is warranted, just as we saw back in end December, early January. The market gets too dovish on the Fed and too hawkish on the BOJ.
Well, the BOJ wants stability. That's the one thing that they crave, and we haven't got that in either direction on this dollar-yen trade at the moment. The data is driving the bus. The steepeners stalled yesterday in the rates market on the back of the GDP numbers, and so too did the yen's ascent. Now, the risk is this for the yen bulls, is that they don't get a hike next week. How important is it for the perpetuation and the momentum of this trade that you get a hike to take you through the 150 level, to that level that Kit Dukes is talking about, 140 rather than 160?
It is important, but to me also forward guidance is equally important, because if the BOJ says, okay, we hike by 10 or 15 basis points and we're done for months, then people will step back and realize that the spread between 2-year Japan and US rates is 400 basis points, and that's a lot to dismiss a carry trade revival in dollar yen. But there's also, again, the BOJ is one part of the equation and the Fed is the other part. And I think it's pretty risky business right now to go tactically long the yen at these levels. Maybe you need to sit it out until those meetings are done. And because, if in the grand scheme of things, if dollar yen is to fall further, the big level chart is watch out for is 140. And that's really, really a long way.
Vasilis, thank you very much. Vasilis Karamanis there on the dollar yen. The crazy yen trade of the week. Well, here in the US, we just had an undeniably solid GDP report highlighting the resilience of the American consumer and businesses despite continually high interest rates. GDP grew 2.8%, personal spending up 2.3%. But what impact will that data have ahead of the FOMC? The UBS chief economist Paul Donovan says this: GDP fails to capture all of the modern economy, a statistic created a century ago in an era of flappers and Al Capone. Is struggling to include TikTok content and side hustles. Let's see whether his colleague Abigail Watt of UBS, the economist team there, agrees with Paul. Who could possibly disagree with Paul? But when we look at that GDP data yesterday, it was pretty strong. Are you as reliant, are you as believing in the GDP data, perhaps as some are skeptical as Paul?
Look, I think it's one statistic, in a wealth of statistics that you can look at on the US economy. There are elements of the AI story that you can look at within the GDP data. They do try to capture, where some of that investment might be taking place. We can see some of that. And I do think there are kind of some signs in the GDP data themselves around some of that AI investment. We have started to see, fairly strong increases in kind of capital goods imports, and that's been feeding into stronger kind of overall kind of investment in the US GDP in the national account. So we have seen, some signs there of that feeding in. So I'm not sure I would discount their kind of inclusion in GDP. I do think, there are ways in which you can look at those data and see how they are feeding into kind of overall growth in the US economy.
Abigail, I know you see a rate hike in September and December. I got to say, where that sounds pretty middle of the road, it's starting to sound more hawkish, considering things we've heard from former Fed official Bill Dudley and Mohamed El-Erian saying that the Fed is at risk of more likely increasing the odds of a recession in the case of Dudley if they don't go in July. Abigail, what do you make of those calls, that a recession is likely unless the Fed acts soon?
Yeah, so as you said, we're expecting to see a cut from the Fed for the first time in September in this cutting cycle. We then think they'll follow that up with a December cut. In terms of their kind of characterization recently around the labor market in particular, which is what I think is driving a lot of the kind of debate and discussion around the kind of extent of cuts that we'll see this year, they changed the characterization there a little bit in recent messaging from various members of the FOMC. We heard them kind of shift away from the kind of strong labor market narrative towards this idea that you maybe are starting to see kind of a kind of more slowing in the labor market. And I do think that is an important shift. But the one thing that I would note is if we think back to where we were, after the June SEP was released, we saw kind of 4 members of the committee signaling no cuts this year at all. You saw an additional 7 saying just 1 cut would be appropriate this year. So I do think, in order for for us to see kind of a greater extent of cutting from the Fed this year, I think we would have to see kind of more signs that they're concerned around the labor market. And, in our expectations, we do have a slowing in the labor market, but we don't have kind of an outright stalling that would maybe drive the need for kind of a quicker pace of cuts from the Fed this year.
How much conviction do you have again around the SAM rule? Because the argument yesterday from the discussion on Bill Dudley's piece, et cetera, is that the 3-month average on the unemployment rate rising by nearly 0.5% over 3 months is a justification. It's a precursor to a recession, and that in of itself should be one of the things that's driving the Fed, and that they are reluctant to accept that. How much of a driver is that for you and the team?
Yeah, so we wrote recently about the SAM rule, and I think the nice thing about the SAM rule is the fact that it can capture some of the nonlinearity, the speed with which the unemployment rate is rising kind of matters. But the other thing to think about is the fact that if you continue to see the unemployment rate just eking higher slowly, you could be in an environment where you don't actually see the SAM rule trigger, right? So I think one of the things that I always say is that, this is one input into the Fed's thinking alongside a wealth of other labor market indicators. They'll be looking to see kind of what we see in the payrolls report next week, the kind of JOLTS data, what's happening in terms of openings and quits rates, and what's happening in terms of kind of hiring rates in the US economy. There's a whole wealth of data that they'll be looking at. And I think the SAM rule is a useful indicator, but it's one of many things that they can be looking at when they're thinking about their decisions.
Yeah, even Claudia Sahm herself has argued against putting too much weight in the SAM rule. So I think that says something. Abigail, you talked about some of the metrics that you care about. How much do you care about this earnings season when we hear consumer-facing companies over and over issue warnings? Everything from plane makers to autos to the discretionary, we knew that was a problem, but to staples too. What difference does that make to you?
Yeah, so I think obviously you can look at the micro level where we were looking at GDPs yesterday. We can look at the micro and we can hear what companies are saying around the state of the US consumer. And I think it can be an interesting input into kind of thinking about what the US consumer will look like going forward. We've been saying for some time that we think the US consumer is going to slow this year. And, we have seen some signs of that. Consumption was fairly robust in the GDP data yesterday, but we, are expecting that we see, consumers coming under increasing pressure. And in particular, one of the things that we've been looking at on the consumer side is this kind of bifurcation between those consumers at the upper end of the income spectrum who are still sitting on relatively healthy balance sheets relative to those at the lower end of the income spectrum who are perhaps showing more signs of stress. So I do think there is kind of a slope for a further slowing in the consumer from here in the US.
Okay. Abigail, we appreciate it. We'll see what the numbers today bring. Abigail Watt of UBS. Okay, let's get to some of the other top stories trending on the terminal this morning. China is considering a fee hike of at least tenfold on high-frequency trading. The country has been trying to rein in some quant strategies. Regulators see them as a threat to fairness in the nation's stock market, which is dominated by retail investors.
Hermes defies the luxury slowdown. Sales jumped in the second quarter. The Birkin bag maker is weathering softer demand better than its peers, thanks to its strong pricing power. it did see softer demand for its more affordable goods, such as silk scarves.
I'm still waiting for Manus to give me my Birkin. Anyway, Moody posted second quarter inflows that surpass analyst estimates. It also helped lift its assets under management to now $2.3 trillion, a record high for them. Inflows at the Paris-based asset manager were driven by medium and long-term products. Its treasury products saw outflows as corporations withdrew cash to pay dividends.
I can get you an aspirational luxury product, but not a Birkin. Not a Birkin.
I'll take what I can get.
Coming up in the show, Apple's iPhone isn't even in the top 5 in China anymore. It lags the local Android brands that prove to be more popular.
Apple has lost ground in China's smartphone market, falling out of the top 5 most popular. Meanwhile, local companies like Huawei have surged ahead in the quarter up to June. For more, let's get to Bloomberg's Tom McKenzie on this. Tom, how should we understand this? Because the data feels as if it's been uneven. Sometimes we hear data that Apple isn't shipping many iPhones to China, and then they themselves in their earnings say that it's somewhat healthy. So what do we make of this?
Yeah, it's a mixed picture, but what it underscores, I think, is a trend that we've seen reiterated over the last few months for Apple, which is that it does not have that glide path, that easy glide path to growth in the Chinese market that it once did. And you're absolutely right, the data has been mixed. You get the government data, and then you get the data from research firms like IDC. Their numbers coming out today with that 3%, more than 3% slide in the second quarter. What's really important is that 3% slide for Apple compares with 11% growth for its competitors on the Android system, the likes of Huawei, Vivo, Xiaomi and Oppo. So the competitive strength continues as a challenge for Apple. And as you rightly pointed out, what this means is they've fallen out that top 5 handset maker, smartphone maker in the Chinese market for the first time, by the way, in 4 years. We did see details coming through in terms of shipments from the government data suggesting that things were picking up. So it's a bit of a volatile data picture, but the top lines are this is a consumer base in China that is challenged. You link that to the real estate sector. They have less money to spend on some of these premium items. They are cutting back. Consumers are feeling under pressure in China. Then you have the competitive threat of the likes of Huawei that just becomes more acute for Apple, and it just becomes that much more challenging for them. Of course, Apple's betting on their AI products coming through. They still hope to ship about 90 million additional iPhones by the end of this year. And then they're looking to other markets like India, where they've seen a 33% or so increase in revenues most recently.
Yeah, well, an awful lot is being banked on that AI upgrade. If you think about it, I just spent whatever on a brand new iPhone when I came to live here last year. Is AI going to take me up over the hill to bang out another $1,000 on a phone? I think it's $1,000 for a phone. Anyway,
Something like that.
Something like that. Sunglasses, Luxottica. It looks like Meta. They've had a close relationship with the maker of Ray-Bans for a number of years. But now we understand they want to try and be a bit more formal, and Meta maybe take a bite and a chunk of Luxottica. What could be behind that?
Yeah, absolutely. Look, I should also say, Manus, you have a couple of options now in terms of the gifting to Danny. If you can't get the Birkin, they go for the iPhone 16 with the AI.
She's getting a scarf.
Some Meta glasses from Ray-Ban and EssilorLuxottica. Look, we've done some reporting about this previously, suggesting that Meta might be taking a 5% stake. Today, the CEO of EssilorLuxottica came out and said that they are looking to take a stake, Meta are, and this is the world's biggest eyewear maker. This is about augmented reality, and it's about getting the AI components and some of Meta's hardware into these glasses. They already had the Ray-Ban Meta out in 2021. It looks like they're going to build into this. Apple, by the way, going back to the Apple story, they have the Vision Plus Pro headset. Meta and Apple going head-to-head in that space, and Meta taking this stake, it looks to be, at least, hasn't been confirmed, in the world's largest eyeglass maker.
We're all going to look good in our new Ray-Bans. Tom, thank you very much. She's getting a scarf, not a Birkin bag.
Ooh, I'll take it.
Tom McKenzie there. We're going to talk a little bit about what JP Morgan are doing with the in-house GPT chatbot. That's next on Bloomberg. Front Page Friday. This is what we got for headlines around the world. Let's kick it off with the Journal. They've got reports that the U.S. intercepted Russian and Chinese warplanes this week. The U.S. and Canadian fighters intercepted 4 warplanes 200 miles off the coast of Alaska. Danny, that was on Wednesday. It marked the first time strategic bombers from 2 adversaries have operated together near North America. The Pentagon chief expressed concern. Understatement.
Meanwhile, the Washington Post leads with this. Harris has called for ceasefire and hostage release after the Netanyahu meeting. Yeah. She appeared to add pressure on Israel and Hamas to close the gaps in reaching an agreement, and notably, she gave the address instead of President Biden.
And she really made a play for saying that, you know, she heard the protesters. So this is a shift. Now, how's your wealth management and your asset management? FT leads with this. JP Morgan lead the charge with a chatbot, an in-house chatbot. This is for the AI across research, and you treat it as, I suppose, a very hard-working intern.
Well, see, this worries me because they say it can do the work of an analyst. This is such an important part of the financial pipeline. You have these analysts who come in, yes, it's grunt work, but they do it and they eventually rise up in the bank or go elsewhere. What happens if that's all replaced by bots?
Well, the one thing about grunt work, or the stuff that you do early in your career, it solidifies your knowledge, it builds you into a much more robust risk taker or detractor of risk. We'll debate that in a moment.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Yen's moment of truth. The latest rally is at risk of snapping as investors brace for rate decisions from the BOJ and the Fed. iPhone's China struggle. Apple loses its spot as the nation's top 5 smartphone makers on quarterly shipment slip. And counting down to PCE, markets await the last round of key data ahead of the Fed decision. Danny, good morning. Bounce back NASDAQ.
Yep, but the rotation is still alive and well, even with the NASDAQ that's up, we'll call it 1% this morning, Manus. Your Russell 2000 futures, they're up nearly 2%. So we're still seeing the rotation, but it's different this time. It's not everything falling, it's everything gaining, and small caps outperforming. The S&P, your future session, up almost 1%. This thing has fallen for 6 out of the past 7 sessions. Your Mag 7 have fallen 13% since their peak on July 10th. In the meantime, Russell 2000 futures outperformed, up a 24 percentage points. That is a big change. Meanwhile, even despite the strong data we got yesterday, there has been yields falling. We're down barely half a basis point this morning. We're at 4.23% on your 10-year yield. But man, as Bank of America just out with their latest research from Michael Hartnett saying that we are one bad payroll away from the end of tech dominance.
Yeah, and he does make this point. He said that stocks could flash a contrarian sell signal if we go for breadth. And the one thing that pretty much every guest that came in and sat on the end of this desk since the start of the year has been waiting for that moment of when they go for breadth. In terms of the wipeout, you gave the percentage. In terms of the dollar valuation of the wipeouts from the July 10th NASDAQ high, it's $2.8 trillion. It's $2.8 trillion of wealth, $2.6 trillion of wealth destruction.
Well, part of what Michael Hartnett talks about is the recent data has indicated that we're on the verge of what he calls an ill economy. I don't know. It's very confusing because you could look at the GDP data yesterday and say this is an economy that is strong. And this is inflation.
And personal spending's up as well.
Yeah, exactly. The consumer is strong despite some weird flex in earnings, which we can get into. But it's a really choose your own adventure market. Depending on what data you see, it's either an ill economy or still a strong one.
But if you think of the past week, you've had Dudley calling for go now, go early. You've had Mohammed El-Arian talking about, you know, you're 2 steps away from a mistake. But here we are. Again, this is the 3rd shoe to drop this week. We're one bad payroll away from this whole momentum ending. And a number of guests yesterday and across the week have said, look, we're not done with this sell-off yet. From Julian Emmanuel through to a number of others, we are still under pressure in this market.
Yep, but Michael Hartnett writes that the bulls are holding on to the belief that this is simply but a healthy correction. Let's get the view of Clear Harbor's Aaron Kennon. He weighs in on some of these market uncertainties, writing, "We are entering a period of historical weakness for markets at a moment when consumers are on their heels and employment tailwinds are disappointing." Aaron joins us now, who is the CEO of Clear Harbor Asset Management. Aaron, it is this divide between those, as Michael Hartnett points out, that believe this is simply a healthy correction or something that has legs and can go further. Which side are you on?
Well, we'll have to see. I mean, I think clearly the rotation that you referenced at the top is still afoot. We're seeing it in the futures this morning, Danny. And I think that's to a great extent a function of the belief that the Fed will cut rates no later than September. And perhaps, the history of rate cuts isn't that they cut and they wait and they cut and they wait. It's often they cut and they cut more significantly because the economic tectonic plates have shifted. And so we'll have to see if that starts to price itself in the market. But we've certainly seen sort of two-sided economic data that is making the Fed's decision a bit challenging as we move into the late summer and into September. You have the jobless claims trending upward, and you have a lot of consumer data suggesting that, yes, while that some of the data is suggesting consumer strength is there, a lot of that is across staples, the necessary goods that need to buy that are still at elevated levels on the margin, rather than things like autos, which we're seeing a rise in delinquencies. Credit card lines of extension are trending higher and defaults are increasing. And so there's certainly some strain on the consumer at this point. I think the Fed is taking note of that.
I mean, when you look at this week, good to see you this morning. When you look at this week, Ford down 18% yesterday. Okay, could be idiosyncratic, but the airlines also saying, warning about bookings. You're looking at Nestle. We're pushing back in terms of prices. What kind of slowdown is beginning to materialize?
Well, we'll have to see. The GDP data was strong, but that's often sort of a in the rear view type of scenario. If you look at the beige book out of the Fed, it's indicating, certainly some significant slowdown around the country in economic activity. Earnings were about 40% through the S&P 500, and only about 40-odd% have met or exceeded top-line expectations. And so that's a relatively historically low number. I think Bloomberg indicated yesterday that's probably at like a 5-year low of beats at only 40-odd%. So this is not just a consumer staple story. This is also, as you know, a technology story where we saw Alphabet. Yes, their earnings were relatively strong, but R&D spend is a big question, and the return on that investment is starting to impact how investors are thinking about things. If you look at mega cap tech trading at 30 times, that's expensive, but the rest of the market's trading at about 16 times. And if you look at, the 4 technology stocks in the S&P 500 are driving the technology return year to date, which is about 22%. About 50% of that return is being driven by just 4 names, and there are 66 names within the technology segment of the S&P 500. So that's not necessarily a bad thing. That can be a good thing. That can suggest that there are things under the hood that are not trading as expensively that could start to gather some steam, and we're seeing that, of course, with the Russell rotation, which has been massive.
It's been massive, Aaron, but can it be sustained if we are worried about the economy, if we are worried about a consumer that is slowing down? Because a lot of the companies in this index, sure, they benefit from rate cuts, but they do not do well in the case of an economic downturn.
That's right. I mean, certainly a recession is going to impact the S&P and the Russell. And but there's also a change afoot here, too. We have an election coming up, and I think part of the Russell narrative is partially a question around tariffs and whether or not the import price piece will increase, allowing for a lot of these domestic manufacturers and domestic service providers, which are heavily represented at Russell 2000, to capture a bit more demand here in the United States. And I think that's part of the narrative. Not to mention the Russell is very cheap on a historical basis, and the S&P is quite expensive, and so. So we'll have to see. But the Russell since July 5th has rallied about 10 percentage points, and the S&P is off about 3 percentage points. That's a 13 percentage point gap there, and it's continuing again this morning, and it continued again yesterday.
Look, one of the big themes that we've been tracking through the week has been the reverberation from the yen trade, from the carry trade. And it's not just been in the FX market, it's been in gold, it's been in Bitcoin. The narrative is the funding currency of choice is now dislocating many other assets. You look at gold from the perspective as being something that can ballast against deficits going into 2025. So when you see drawdowns in gold like this, along with the equity drive-by, what does it say to you? Is that an opportunity to pick up other havens as well as bonds?
Yeah, I still think gold's a reasonably good diversifier in this moment where our deficit spending, both here in the United States and around the developed world, is very elevated. In the United States, it's at World War II type levels at about 7% of our GDP. I mean, that's insane. And both candidates for president are not talking about this, and they need to. And so it would seem as though this challenge around deficit spending is going to continue. That QE may come into play again, that the irresponsible nature of the U.S. Treasury is coming to the fore. We here at Clear Harbor look at gold as just an alternative currency. It's just not manipulated to a great extent by central banks like a fiat currency. And so we just think about gold in that context. And we think when there's irresponsible deficit spending in the world, when there's QE, and when we're running deficits at 7% debt to GDP with no end in sight, we think gold is a reasonably good diversifier and a piece of ballast that needs to be represented, or at least should be considered in a portfolio.
Okay, Aaron, thank you so much for being with us. That's Clear Harbor's Aaron Kennon on the markets. Coming up, airline stocks rallying after the results from American and Southwest. Is there pressure in the sector underneath the wings?
Meanwhile, over in Washington, the Obamas have officially endorsed VP Harris for president just 40 or so minutes ago. Here's the video the Harris campaign has released.
Kamala.
Hello. Hi.
Hey there.
Oh, hi, you're both together. Oh, it's good to hear you both.
I can't have this phone call without saying to my girl Kamala, I am proud of you. This is going to be historic.
We called to say Michelle and I couldn't be prouder to endorse you and to do everything we can to get you through this election and into the Oval Office.
It's Bloomberg Brief. I'm Manus Cranny alongside Danny Berger in New York. So the latest airline results show an industry that's facing pressure to cut prices. You've got delays on aircraft deliveries. You've got rising costs. American Air is just the latest to cut its outlook. Next week, we're going to hear from JetBlue, Allegiant and Sun Country. For more, let's get to our aviation reporter, Sid Phillips. So, Sid, look, American, you could say, has had a couple of missteps, but there's a theme here. Ryanair in Europe say that they're having to cut prices. American are trying to aggressively rebuild their relationship with corporates. How bad is it from the demand side?
Morning, man. So there is a demand. Demand continues to be around, but the price is, it's about ticket price and when will people be willing to pay for tickets. And I think that's where the airline industry is sort of struggling in terms of yield, because American, Southwest, all of them have had costs that have risen sharply in the past couple of years. And at the same time, passengers aren't willing to pay those high fares that they were willing to in their sort of rebound from the pandemic. And that's where the airline industry, especially the carriers in the US, because there's a glut of capacity in the domestic market. So you've got the likes of sort of Southwest, you've seen American cut its outlook twice for the year. And that's all based on the fact that there isn't, people aren't willing to pay as much, and airlines are being forced to discount tickets in order to fill those seats up.
Yeah, it feels like a shift that happened so quickly, Sid, because it was everyone and their mother was going to Europe or Japan. Sid, we appreciate it, Bloomberg, Sid Phillip. Okay, over here in the U.S., we have some data on tap. We're going to get June PCE at 8:30 a.m. New York time. We'll also get personal income and spending numbers, which should show some household finances that are getting stretched. Bloomberg International Economics and Policy correspondent Michael McKee joins us now. Mike, just set us up. What are we expecting?
Well, we're expecting good news. We saw yesterday the GDP numbers that the spending numbers are probably going to be reasonably good, up from last month, 0.3 compared to 0.2. But it's going to be an interesting day because you look at what's supposed to happen with inflation, expected to continue to ease and come down. But here's the dilemma for Wall Street. Inflation goes down. Oh, the Fed can cut. Spending goes up. Oh, the Fed better not cut, which was kind of the reaction we saw yesterday. So it's going to be really interesting to see. And this is going to be three-digit Friday, because we see a forecast for 0.1% on headline and a 0.2% gain for core. But it depends on rounding, too. So if numbers round up, we could see a slightly higher than expected inflation number. It'll be interesting to see how markets react to that.
It's interesting because the cover that they need or that they want to give them the more time was evident yesterday in the GDP and in the spending. And maybe if this just comes in line, it gives them that window for anything else that can happen in this next 6 weeks.
That's basically what the markets are thinking at this point. We've pretty much priced in 3 rate cuts over the course of the rest of this year and then into 2025. That's fairly aggressive. Do they need to do that? I don't think the Fed is along with the markets that far out, but we'll see today if we get any kind of reversal in market thinking about where we're going to be based on what we get from the spending versus the numbers on inflation. Also, we get the University of Michigan at 10 o'clock with the inflation expectations numbers, if those are kind of out of line. But we're right now where the market thinks and where the Fed has said they want to be when they want to start cutting. So,
okay, as you say, it's a pretty punchy assumption by the market in terms of the trajectory for cuts. Mike, thank you so much. We'll count down to the data with Mike McKee on surveillance a little bit later on today. Let's get to Paris. Guess what? The trains to and from the capital were hit with what authorities called a massive attack aimed at paralysing the network of France's super-fast trains, just hours ahead of the opening ceremony for the 2024 Olympic Games. Caroline Connin is in Paris. Caroline, allez les bleus. That's what we'd say to you. But look, this is the last thing that France and Paris needs. 800,000 customers possibly delayed getting to Paris for the Games. Just tell us what's happened on the TGV and how serious an impediment is it to this opening ceremony?
I mean, it is pretty serious given we're just a few hours away from the opening ceremony, which is going to take place right here in the city along the Seine River for the first time, not in the stadium, but in the city. As you mentioned, as many as 800,000 passengers could be stranded. The TGV lines that have been affected are going towards the west, the Atlantic coast, the north towards north of France and towards the Eurostar to London, and the east towards Belgium, Germany. All these lines being affected by some coordinated sabotage. The southeast of France going towards the French Riviera has not been affected because the SNCF agent managed to catch those activists who were trying to damage the rails. I was talking to a few CEOs this morning right here, Accor Deputy CEO, Danone CEO, who said that it is very sad that some people are trying to take the Olympics hostage, but it's not going to ruin the party. The party tonight right here in Paris expected along the Seine River. As many as 6,000 athletes are going to sail down in boats with a big finale at the base of the Eiffel Tower.
I gotta be honest, Caroline, it seems every trickle of information we get about the Paris Olympics hasn't been great. From this to just the demand, that doesn't seem to be as good, whether you look at local businesses complaining or ticket prices for, not ticket prices, hotel prices for rooms lower than they had been at their peak. Is there a demand issue?
As many as 15 million visitors are expected in Paris during the Games. But as you mentioned, there's been some concerns because those tourists, those wealthy tourists who usually come to Paris during summer have been avoiding the city if they are not attending the Games. So the peak rate, for example, for hotels, which was 11 months ago, we're down about 40% from that peak rate in terms of average rate for hotels in July. Also, the airlines Air France, KLM, who's also a sponsor, has warned about revenue shortfall of as much as 200 million euros because of those tourists not coming if they're not attending the Games. But then, obviously, you have those businesses who are benefiting. I was talking to Accor this morning, big sponsor. They are at 80% capacity, which is better than last year, about 10 to 12 billion euros. This has been the cost of these Olympic Games, and according to some economists, in fact, this could have an impact on GDP of 10 billion euros as well. And the effect of the games on the city, on businesses, on economic activity could last up to 10 years.
Caroline, we appreciate it. Enjoy the games. Bloomberg's Caroline Kennon in Paris. And later today, speaking of hotels, Airbnb CEO Brian Chesky will be on at 10 a.m. in New York on some of that lodging demand during the Olympics. Mance, let's get a quick check on these markets because the rotation is alive and well. This morning it's taking the form of everything, of all boats rising in this tide, but Russell 2000 futures up 1.5%. We're just catching up with Aaron Kennon of Clear Harbor Asset Management, who said that this is not just an economics trade, it is a tariffs trade for local businesses, local manufacturers that benefit off the back of them.
Yeah, but then the counter argument of that is, of course, you've got the Russell to the big tech outperforming, but if there is a harder landing, as you say, that's when the trouble may brew for the Russell. Coming up on the show, it's Friday, so we'll set the agenda for you for the rest of the day and for next week. Context matters every day on Bloomberg. What a beautiful dawn.
It's your Bloomberg Brief on this Friday. I'm Danny Berger alongside Manish Cranny in New York. Let's get you set up for your trading day now. We're going to get a lot of data, U.S. personal income and spending, plus PCE. All of those come out at 8:30 a.m. Eastern. That will be followed by the University of Michigan Consumer Sentiment. That comes at 10 a.m. Plus, we're going to close out a busy week of earnings where a third of the S&P reported. We'll get 3M, Bristol-Myers, and Colgate-Palmolive. All of those report before the bell.
Okay, well, all eyes down on those. Now, there's a couple of individual stocks which are certainly worth keeping an eye on. And this is actually a turnaround. We started the show with the Nasdaq up about 1%. That momentum has improved. Nvidia's up 2.4%, turning it around. ADM up 2.7%, and Broadcom. So again, the chips are leading. I think what you've got here, Danny, is a week of reflection, which is the Fed, the timing of the Fed, the AI trade, that big AI trade, and of course the consumer. And then if you think about what Bank of America have said, I really, really like the line, which is, we are one, this is Hartnett's note, Bank of America, Hartnett's note, we're one bad payroll away from, the big tech dominance ending. That's quite a call.
It is, but I have to say most of the calls around tech have centered on the fundamentals, and that's part of the reason why this rotation trade has picked up some steam, specifically with Alphabet earnings. Because you have this idea that they've spent more than $350 billion in R&D just this year, just in the first half of this year, in order to get that AI capabilities built in. And investors are going to start looking at that and saying, if you don't monetize that, if there's not a clear path to that of profitability for that, you've overspent, and we're not willing to own these hyperscalers. Again, we're going to get more tech earnings. You could possibly argue that that would be more damaging for tech names than the payrolls.
Well, all of their capex are going to rise, probably. That number in Alphabet is up by 80%, $13 billion, up 80% from last year, and that's really what shook the market. In terms of the differential between the Russell and the large cap, and our last guest just said this, is that you have the Russell rising by 10% since, the space of July, since the start of July, and the S&P down by 3%. So that trade is not dissipated. This is about a couple of big rotations in bonds, in yen, and indeed a big tech to Russell.
I was going to say, part of the thing that's probably giving us relief this morning is that we don't have another session of yen appreciation. It's little moved this morning because it is a very normal trade to be something like short the yen, but also long treasuries, and at the same time, long U.S. equity. So you get a little bit of relief there, and then does it unwind further if we get a BOJ that doesn't live up to hawkish expectations?
Well, the yen rally stalled yesterday on the stronger U.S. data. You're counting down to a Fed meeting and the BOJ, and still the punting is not that the BOJ will hike yet. So maybe yen rally has run out of breath for now. Surveillance is up next. Good morning from New York.